Have you ever wondered why some people seem to get richer during a crisis, while most of us are just trying to stay afloat? It's not just luck. It's a strategy, a dark playbook that's been used for centuries. Today, we're pulling back the curtain on how fortunes are made from chaos. Picture this. The stock market is plummeting. Headlines are screaming recession, and there's panic in the streets. Your first instinct might be to sell everything, hide your cash under the mattress, and hope for the best. This is exactly what the average person does. But a small group of investors does the complete opposite. This is the core of the strategy, capitalizing on fear. Let's call it the contrarian offensive. When everyone is zigging, they zag. When fear is at its peak and asset prices are at rock bottom, they see a once-in-a-generation buying opportunity. Think about it. During the 2008 financial crisis, while major banks were collapsing, and people were losing their homes, investors like Warren Buffett were quietly injecting billions into companies like Goldman Sachs. People thought he was crazy. But he wasn't buying the panic. He was buying valuable assets at a massive discount. Years later, when the dust settled, his investments had multiplied in value. This isn't just about stocks. It happens in real estate, too. During an economic downturn, foreclosures rise and property values drop. While families are tragically losing their homes, large investment firms and wealthy individuals swoop in, buying up properties for pennies on the dollar. They might hold on to them as rentals, generating cash flow, or simply wait for the market to recover and then sell for a huge profit. It feels predatory because, in many ways, it is. They are leveraging the misfortune of others to build their own wealth. So what's the first step in this dark playbook? It's all about liquidity. Having cash on hand when a crisis hits is like having a superpower. Most people have their money tied up in their homes, their retirement accounts, or other investments. They can't access it easily. But the ultra-wealthy make it a point to always have a significant portion of their net worth in cash or near-cash equivalents. This is their dry powder. When the storm hits, they're ready to deploy this capital instantly, without having to sell other assets at a loss. This readiness isn't accidental. They spend years, even decades, preparing for these moments. They study historical cycles, they watch geopolitical tensions, and they analyze economic indicators. They're not just waiting for a crisis, they're anticipating it. They know that periods of economic expansion don't last forever. A downturn is not a matter of if, but when. So while the rest of the world is enjoying the party, they're preparing for the hangover. The second key element is information asymmetry. They have access to better, faster information than the general public. They pay for premium research. They have networks of experts, and they're often connected to the inner circles of finance and politics. This gives them an incredible edge. While you're reading yesterday's news on a free website, they've already acted on information that won't become public for days or even weeks. They can identify which industries will be hit hardest and which are likely to receive government bailouts, allowing them to position their investments with surgical precision. Let's look at the dot-com bubble burst in the early 2000s. The hype was insane. Any company with "com" in its name was getting billion-dollar valuations, even without a real product or profit. The public poured their life savings into these tech stocks. But the smart money, the insiders, saw the writing on the wall. They saw the absurd valuations and the lack of fundamental business models. Many of them started shorting these stocks, which is essentially betting that their price will fall. When the bubble finally popped, the public was wiped out. But those who shorted the market made an absolute fortune. They profited directly from the collapse they saw coming. This strategy also heavily relies on psychological fortitude. It takes incredible nerve to buy when everyone around you is screaming to sell. Our brains are hardwired for herd behavior. It feels safer to follow the crowd. Going against it triggers all sorts of internal alarms. This is what separates the pros from the amateurs. They have trained themselves to disconnect emotion from their investment decisions. They operate on logic, data, and a deep understanding of market psychology. They know that maximum fear equals maximum opportunity. Now, let's talk about the more controversial side of this. Profiting from destruction. During a crisis, certain sectors thrive. Think about it. In a pandemic, pharmaceutical companies and manufacturers of personal protective equipment see their stocks soar. During a war, defense contractors and energy companies can reap massive profits. Investors who anticipate these shifts can make fortunes. They're not just buying discounted assets. They're investing in the very tools and services that become essential during a specific type of crisis. For example, after a major natural disaster like a hurricane, companies involved in reconstruction, building materials, and logistics see a huge surge in demand. An investor who buys stock in Home Depot or a major construction firm right after a disaster is essentially betting on the rebuilding effort. It's a grim calculation turning tragedy into a financial gain. So how can you, as an average person, protect yourself or maybe even learn from this? First and most importantly is to avoid panic. When the market is crashing, the worst thing you can do is sell your long-term investments out of fear. You're likely just locking in your losses. Second, start thinking about liquidity. It doesn't mean you need to hoard millions in cash. It just means having a healthy emergency fund. This fund isn't for investing. It's your lifeline. It's what prevents you from being forced to sell your assets or go into debt during a personal or economic crisis. This financial security gives you the breathing room to think clearly when things get chaotic. Third, educate yourself. You don't need access to secret information, but you do need to understand the basics of how markets work. Read books, listen to podcasts, and follow reputable financial educators. Understand that markets move in cycles of boom and bust. Knowing this history helps you put current events into perspective and not get swept up in the mass hysteria. Fourth, adopt a long-term perspective. The most successful investors aren't day traders. They are patient. They buy quality assets and are prepared to hold them for years, if not decades, through all the ups and downs. If you're investing for retirement in 30 years, a market crash today is just a blip on the radar. In fact, if you continue to invest regularly during a downturn, you're practicing a version of this contrarian strategy yourself. It's called dollar cost averaging, and you're buying more shares when prices are low. The strategy of profiting from crisis is a stark reminder of how the financial world really works. It's a game of psychology, preparation, and sometimes ruthless opportunism. It's not about working harder. It's about positioning yourself to benefit from predictable patterns of human behavior and economic cycles. By understanding this playbook, you can at least avoid becoming its victim. You can learn to control your fear, stay the course with your own financial plan, and maybe just maybe see a crisis not just as a threat but as a disguised opportunity. It's a powerful and often unsettling truth. In the world of finance, chaos is a ladder. And those who know how to climb it are the ones who come out on top time and time again. Thanks for watching. If you found this insightful, don't forget to like, subscribe, and hit the notification bell for more content that dives deep into the world of money and power. See you in the next one.